Welcome to your Essential Business Briefing. I'm Stephen Carroll. Coming up, what can be done to save the economy from coronavirus? As the outbreak spreads, we look at the options open to policymakers. Wild swings on the stock market as firms warn of damage to profits, but how transparent are companies being with their forecasts? And no show for carmakers in Geneva as the virus hits both suppliers and customers for carmakers. Now, first up, global growth could be cut in half if the coronavirus outbreak continues to spread. That's the warning from the Organisation for Economic Cooperation and Development. Its latest forecast outlines two scenarios. First, if the spread of the virus peaks in China before the end of this month, and another if the outbreak worsens and spreads in other parts of the world. Under the contained situation, global growth would be trimmed, according to the OECD, to 2.5%. And if properly managed, China's annual growth would fall to just under 5%. A more prolonged and widespread outbreak would see a much more serious impact on the economy, though, reducing global growth to just 1.5%. If the situation does get worse, what can policymakers do? Brian Quinn's here to fill us in. Brian.
Well, Stephen, one major area where the OECD has called for action is in fiscal policy, essentially tax and government spending. Italy, so far the hardest hit European country, is planning to inject some €4.5 billion into its economy via tax credits for businesses, healthcare funding, and aid to northern regions. For Hong Kong, €13.8 billion in tax breaks and financial aid, including over €1,100 cash for every adult permanent resident. In China, the outbreak's epicenter, businesses are getting around €128 billion worth of breaks on social charges. There could be more action on the way, too. Finance ministers from G7 countries agreed they'd take, quote, timely and effective measures, including on tax, but didn't offer any quick fix, while the World Bank has committed almost €11 billion for healthcare in developing countries, which includes cheap loans, grants, and expert advice. Policymakers' other main arm is monetary policy, which is how central banks control the money supply. The U.S. Federal Reserve has slashed interest rates by 0.5 percentage point in a bid to prop up the American economy. Australia, as well, has cut its rate 0.25% to historic lows. The European Central Bank, meanwhile, says it's ready to take, quote, appropriate measures, which may include pushing banks to lend to small businesses. But how much can central banks really help? Rate cuts boost demand by encouraging borrowing and investment, but the virus's economic fallout is largely due to disruption in supply. And if demand does take a hit as consumers stay home from travel and public places, cheap loans are unlikely to make much of a difference.
Brian, thank you very much for that. Now, all of this drama has been playing out on the stock markets. We saw many markets enter correction territory after slumps on shares of more than 10% in recent days. Steps taken by governments and central banks have sparked small recoveries, but the rough ride for investors looks set to continue. Let's get more on this from Justin Urquhart Stewart, co-founder of Seven Investment Management. He joins us now from London. Justin, good to see you. What is it about an event like the coronavirus that causes such wild swings on the markets like we've seen in recent days?
Well, it's all about really one word, and the one word that governs not just the economy, but also stock markets as well, and that is confidence. If you can't measure it, see what effect it's going to have, markets will always try to look on the dark side until they can grab hold of something, which is it's going to cost this much, or that government or international bodies are finally taking action. So compare it with previous disasters like the BP accident, say, in Mexico, in the Gulf of Mexico. After a while, you could start seeing what that would cost. It was still very painful and took a long time to recover, but you could measure it and it got the confidence back. Unfortunately, what the virus is doing is sacking out all of that confidence, and that hits the economy, it hits the stock market, and really hits people actually making decisions about where their business goes from here.
Were you surprised the Fed acted so quickly?
I was really quite surprised by the way the Fed has acted quite as fast as this, and also just cutting rates, because in effect rates are already at zero. Certainly if you take into account inflation, they're negative rates, so it doesn't really have that much real impact. But on the other hand, they wanted to be seen to be doing something, and so here's something that they can actually wheel out and give to the market, and the market liked it immediately, and then actually thought for a second or two and say, what impact does that really have? And the answer is astonishingly little.
We are getting this slew of warnings from companies about how they're going to be affected by the virus. The wording's vague in a lot of cases, to be honest. What can companies tell us, or what should they be telling us at this stage about how their businesses are going to be impacted?
It's very difficult for them indeed, because every winter we always have some form of epidemic of different levels. Normally it's just ordinary types of flu, so you can't measure it. But all companies should, as a natural order of things anyway, be having standby procedures, just as much as if you had, for example, an interruption of information flow, electricity, other power support sources, so you have backup services. The problem is that if you find, say, a quarter of your workforce is signed off being sick for a while, that means that part of your business really is going to be very stuck indeed. And certainly if you're dealing with trading in those sort of areas, it could leave you open to exposure and not have the right people in place at that time.
We've had warnings from financial regulators in the UK and here in France telling companies they need to warn investors and thus the public of troubles they might have down the line as soon as possible. Is that a hint, perhaps, that they're not being as transparent as they should be?
Well, they've always got to be careful, both governments and regulators, because if they do something too dramatic, then they're accused of overreacting. Equally, if they try and play it cool and say it's going to be fine, they're accused of them being lazy and not taking any action. So you're damned if you do and damned if you don't. Really what they've got to be able to do here is to show that they have actions that they can take if they need to, for example, in terms of extra support, reducing taxation, bringing forward government expenditure, which would make up for the shortfall of this, on the assumption that this is going to last a few weeks or months, certainly till the summer comes, when hopefully the virus will then find it more difficult to survive.
Some of the warnings from companies have just sort of hinted at a slightly lower level of sales, usually reducing a range in the cases of, I'm thinking of companies like Visa and MasterCard.
Oh.
What should we be looking out for as companies give us more updates on this matter? Should we expect them to say, oh, well, actually, it's going to be a loss instead of a profit, or will they not quite go that far?
Well, what they should be doing is putting out a message which is actually, apart from anything else, heading towards the truth. But equally, of course, you don't necessarily want to scare everybody if you think it's going to be very difficult indeed. But you have to give people the idea that actually, A, you're doing something about this and you have a plan. It doesn't come as an astonishing surprise. And B, yes, there is an impact, but this is how we're actually going to try and manage it. If a company doesn't put a statement out at all, then that's just really rather stupid, and the market will then assume the worst. If a statement is put out and it patently doesn't look as though it's credible, the same thing happens as well. So it's a very difficult path. Yes, they should communicate, and it should be realistic and credible, and not trying to come out with either schemes saying it doesn't affect us at all, or that actually we are so strong we can actually withstand all of this. Nobody knows at the moment, and anybody, every time you say that, markets get nervous.
I hope you don't mind me saying that you're a veteran of the financial markets. When you compare this to previous crises that you've traded around and watched, do you see this as being one of the more serious?
It certainly is more serious, not because necessarily I have any particular knowledge of the virus, none of us have, but actually because it shows the connectivity of the globe. And we've talked about globalization for many years, but here you can see its impact very directly indeed at the speed of the effect. So, for instance, take, the manufacturing chain that goes towards making toys in China and being ready for the Christmas this year. Well, that's already being affected, and we're 9-10 months away from it. So what's happened now is you've got a bigger economy, more interconnected, and therefore it can have a broader scale of hitting that confidence much more easily than, say, for example, when we went through the SARS issue or the MERS issues as well. So it's bigger and nastier, and it can have a greater effect because there's an interconnectivity. All the more reason, therefore, for regulators, companies and governments to tread very carefully here in order to take the citizens with them, to have enough confidence to say, stay with it, it's going to be all right in the medium term. And as for investors, do not sell out now because the market's already gone down. Investors should look at actually compounding returns over time with their dividends. That's how you grow money, not by trading and listening to silly gits in red braces telling you what to do.
Well, plenty to keep you and I busy anyway in the coming weeks. Thank you very much, Justin Urquhart Stewart from Seven Investment Management, for speaking to us.
Thank you.
Now, the Geneva Motor Show has been one of the many industry events that's fallen victim to efforts to contain the crisis. This at a time when the motor industry is also feeling the strain of the virus outbreak. Factory shutdowns in China are having a knock-on effect for car makers around the world, while demand has been hurt too. Peter O'Brien reports.
This is the Peugeot.
A big win for Peugeot, but no applause.
Beautiful. Congrats to Peugeot, well done.
With the cancellation of the Geneva Motor Show, the Car of the Year ceremony was live-streamed. Peugeot execs celebrated, but it's hard for the industry as a whole to get excited with the coronavirus slamming sales and frustrating production. Across the EU in January, passenger car registrations dropped more than 7% year-on-year, and commercial vehicle registrations fell more than 11%. And it's not just results that have been affected. A BMW employee in Munich caught the virus, and some 150 of his colleagues are under quarantine. Despite everything, board member Peter Noter remains optimistic.
Well, we expect in 2020 to have another record year of sales. So we expect slight growth. And although Corona, yes, will have short-term some impact, it is much too early to say what the impact on full year will be.
The picture is bleaker in Asia. Car sales in China, the world's biggest auto market, fell more than 90% in the first half of February, while in South Korea, the country's 5 biggest car makers' domestic sales plunged more than a fifth in the same month. As factories in China struggle to reopen, supply shortage is having an impact across borders.
Up to now, we have a supply chain which is very stable, but we have to monitor it every day.
One market which hasn't yet been hit hard is the US. February was a strong month for dealerships. General Motors has, however, warned that production outages could affect its domestic plants. The scramble to react to the virus and secure supply chains has exposed a vulnerability in the industry, an over-reliance on China.
That's it from us for this week, but a reminder that you can listen back to this and previous episodes as a podcast, and you'll find the best of our business coverage on our website, on Facebook at France24 Business, and you can tweet me with your questions at NewsStephen. Until next time, thanks for watching.